Welcome back to 20 Minutes of Clarity.
I'm your host, Jason Noble, and with me today is Andy, the man merchant. And we're going to do a special edition today talking about 2025 tax reform. Okay, this is what I want you to do. I want you to pause right now, get a pen and paper, take down some notes because we're going to be getting into very important, serious information. And it's at the time of this conversation and recording, what we're going to talk about is tax facts. Okay, we always talk about the facts. Give me the facts, man. Right, is what we're going to get into. But no, we live in a very dynamic world, don't we? And unless you've been living under a rock, right, you have no idea what I'm talking about. Which is kudos to my marketing team of getting this podcast to you. No, you see the dynamics of what's going on in today's world in this economy. And so with taxes, this is another thing that is on the docket of 2025. So Andy, what are the main things that are going on right now within tax reform coming into 2025?
Yeah, well, I mean, let's just set the stage. I mean, nobody really likes to pay taxes, but we all want the benefits that come with what our tax dollars provide us, as Americans and as citizens, and just the enjoyment. So I want to take a step back just as we think through the reform that is coming out because it's a big year. But there's really kind of five main fundamentals that I kind of pulled out of it just to talk to people about. Is one, and we're hearing a lot about it right now or recently, is funding government operations, right? That's a big part of what the Doge team is trying to figure out is our tax dollars being used in the most efficient manner as far as funding government operations. So that's kind of the first thing that our dollars go to. It's necessary to have a government who does the things for us, but the difference is how much should be going to that. The second one is our tax dollars are really used for the redistribution of income. I mean, there's a lot of social programs out there that are very necessary for for us to be Americans. It's for what we do, and so part of our money does go to that. It goes to supporting the lower income programs or the less fortunate needs that are out there. So that's number two. The other one is economic stabilization. We see this a lot of times from the federal central bank when they have to come out, and you think about quote COVID and all the money that was pumped into the system that came from our tax dollars, right? So it was kind of a return of our money to re-stimulate the economy. They'll change that, but they'll do it to really stabilize the economy, which is an important factor that our tax dollars go to. The other one, which none of us really like, is regulation. Some of the dollars go to providing programs and certain departments that provide regulation oversight, and that could be for protection of us. And there's a lot of that also being kind of brought around in question. And then the final one, which we talk about with our investors, it's really there to encourage specific behavior. We're coming out of the Biden administration and the green deals that we've heard about. And you remember you could buy a car that was energy efficient and get credits for it. They'll provide credits for home and businesses. We talk all the time about how the tax code is about a partnership if you're on the right side of the partnership of tax dollars. But part of your tax dollars goes to providing some of these bigger initiatives and bigger incentives to encourage a certain behavior. So those are the five. I think it's really important, Jason, that we highlighted that because sometimes we can talk about all the noise that's going on right now about tax reform and, the Republicans want this, the Democrats. We don't care what side of the aisle you live on, right? This is not about the side of the aisle. This is about personal. This is about your money. Where is your money going to? Your hard-earned dollar that you take out of your paycheck, it has to go somewhere, right? And so that's what we're going to talk about today. But there's our highlight that I wanted to kick us off with.
Well, yeah, I mean, every time there's a change to tax policy, it oftentimes comes with a lot of confusion. And that being the main reason why you reached out, Andy. I just want to tell everyone off camera that Andy reached out goes, we really need to do a special edition to 20 Minutes of Clarity just to talk about the tax policy changes that are set to expire at the end of this year if nothing is done in Washington. And I will say money is green. It's not blue and it's not red. Okay. And I love what Andy was saying earlier. But this is where you could take this information, you could sit with your accountant, your financial advisor. If you don't have a qualified accountant, if you don't have a qualified advisor, that's where you go to clearpicturefinancial.com, understand more of what we do, click the links, watch the training videos. You have access to a lot of content there, but then schedule time to speak with one of us. So let's get into it.
Yes.
Individual tax rates set to change with the Tax Cut and Job Act expiring at the end of this year, meaning we go back to the tax rates of pre 2018. So, Andy, why don't you talk
Yeah.
more about the Tax Cut and Job Act expiring at the end of this year?
Yeah, and just take a step back so those can kind of hear what we're previewing. There are really some major elimination, tax back in the first Trump's first administration. He brought out the Tax Cuts and Jobs Act. Wow, that's a mouthful. That provided a lot of the benefits, tax reform originally that we're living on. And so what we're going to do is really highlight 5 of the ones that are set to expire, I mean, go away. You're not going to get them anymore unless something is being done. So the first one that Jason just highlighted, yes, they expanded the tax breaks. They added some columns or some brackets in there. It's pretty simple to say that your individual tax rates, if nothing get done, will end up going up. So you will move into the pre-2018 brackets, which then therefore the same dollar you earned this year going into next year means that you're going to pay more taxes, or more of your hard-earned dollars are going to go to taxes if something's not done. So that is a big part that they're looking at within that, is to extend some of the lower brackets so that individuals are not going to be in these higher tax brackets they want to. But I think that's the biggest one that everybody will feel. Doesn't matter the level of income you have, your bracket will likely change if nothing gets done around individual tax rates. Simple as that.
Yeah, and you're seeing it across the board from all the different rates. The other one is standard deductions.
Yeah.
Yeah, I mean, I've been saying to clients like, hey, so when you're doing like QCDs, that's a big benefits, and then you're going to hit your itemized deductions because of the standard deduction is so high. However, that's being reverted back as well to the pre 2018 tax reform, and so standard deductions are also going to go down. Okay, but so maybe if you itemize, maybe that's a good thing, maybe. But then I don't know many people who are dancing in the streets like, yes, I get to itemize once again, right?
Yeah.
Like, no, taking that bird in the hand with the standard deduction was in a lot of cases higher than when they could even itemized.
Yep.
So having that being pulled down, so if you're picking up what we're putting down here, higher income taxes on the individual brackets, higher percentages, to then get lower standard deduction means more money going to Uncle Sam's pocket, right?
Mm-hmm.
Less into yours, more to Uncle Sam's.
Yep.
That's the second one. What did you want to say in addition to the standard deduction?
No, I think
I'll have you
I think
take
you
on
nailed it.
this one. Yeah, I mean, when I say they're landing once a podcast, that's why you're called Andy the Man Merchant, and I'm not, right? I'm just dropping knowledge noble. But let's get into the child tax credit. You can't just give yourself a nickname. This was called to me by one of my clients, okay? So those that are watching and listening,
Yeah.
I just didn't do that, okay? That came from somewhere. But the child tax credit, talk about that for us, Andy, please.
Yeah, I mean, that's a quick one. I mean, that's one that's phased out. So maybe a lot of people are listening to this. They're like, "Oh, I don't have kids. I don't meet the income thresholds." But the reality is right now it costs a lot to raise children, right, Jason? You and I both know that. If you meet in those core income levels that probably need as much of those dollars back in a direct tax credit, not a deduction, not an offset, not a rate change. It's a dollar for dollar reduction, and so that is set to revert back. And we know that our kids and our cost of living right now and supporting our children is not going down. And so that's just a number to be aware of, that if the child tax credits have mattered to you for the past 3-4 years, that is set to go down as well. So as Jason's highlighted, you got higher tax brackets or more or less higher cost of your tax brackets. You're going to have lower deduction amounts, and you're going to have lower crediting. All of this results to you're probably going to take home less money in your paycheck. That's the core of the first three, is really about what you're going to feel immediately out of your paycheck.
But what about like estate tax exemption? Because I know the Tax Cut and Job Act doubled that estate tax exemption.
Yeah.
How does that play into estate planning, financial planning for our clients if that comes to fruition and that also reverts to lower levels?
Yeah, that's a big one, right? I mean, most people haven't worried about it for a number of years because the limit is so high. And right now, let's just use, it's roughly call it a little over $14 million of any net worth value you have in your estate for an individual. So two people's roughly 28 million of your dollar at death does not go to an estate tax limit. Now, we're not going to go into the huge detail of what this is. There's a whole nother podcast that could probably be said. But the message is for those that are above those net worth numbers, or really what's going to revert to is about 50% of that number. So your 14 is going to go to 7, and those are all going to be subject to change. So 7 would be 14 million for a married. Still a huge number. But there are people out there, and what we're talking to people about on this is that if you've got a $25 million net worth today, you may not have the pain of what estate taxes are going to be tomorrow if you die. Now, as of January 1st, 2026, that same one day from just a sleep to awake, you could wake up, and if you died the next day, that estate tax, if you had that 25 million, is now in a play. So it's about these are things that you have to be proactive about. You can't be reactive. We don't know when we're going to die or not die. We don't know what those numbers are going to be when they do. But the problem is do you want to work hard, build assets, build net worth, take risks just to be able to have a larger chunk that you may not have been aware of go to estate tax when you could have done a few things? So for those that are in that category, we are working really, really hard with our clients right now and their attorneys to make sure that their wealth plan and their liquidity is in place. So that's the big one that I'm talking about. And I know you're going to bring it home with the last one. I know, Jason, you and your team do a lot with business owners and business transitions, and maybe just highlight the QBI loss, and then we'll go into what's on the docket proposals.
Yeah, with qualified business income deduction is the QBI, and the Tax Cut and Job Act introduced the deduction allowing business owners that meet certain criteria to deduct up to 20% of qualified business income. Without extension, this deduction will disappear, increasing a tax burden on individual business owners. And like I say, already having this conversation with business owners, this going all the business owners, but think about how many small businesses are in your local community that really rely on this QBI, so they can then maybe provide additional benefits to their employees, so that they could expand their operations. There's so many different things that come with a business owner is saving money on taxes. A lot of them think about reinvesting that back into their business. Not all of them. Yeah. Some pocket that money, okay, and that's their decision. But I would say a lot of our conversations, they're going, hey, I saved this money on the QBI. Let's take a look at our operations, and maybe I could offer some better benefits, key person insurance, and some of this other stuff that comes out. So now it's going into, okay, if this does go away, looking at your free cash flow with these baked-in assumptions now, what are the things that you have to pivot on? You could imagine this could have a bigger impact on the economy. I'm not saying the other ones that we discussed don't, but when you start messing with business owners' taxes, they find a way to pivot and make adjustments, and it's usually not at the benefit of the employee. Okay, and listen, I know you're watching, you work for someone. Do you go up and say, hey, what are you going to do on the adjustment of the QBI? If they give you a blank stare, I know what you're talking about, okay, you could say, hey, listen to this podcast, reach out and start getting some help, because you're going to want to plan ahead for this.
Yep.
Now, what are several tax reform proposals that are under consideration? Because now we talked about what is most likely going away under the Tax Cut and Job Act if there is no extension of the Tax Cut and Job Act.
Yeah.
So what's on the docket and under consideration right now?
Yeah, I mean, there's a couple big ones that we'll highlight. Again, I think this is the biggest one that's gonna be moving around a lot. But I think the biggest challenge right now is how do they provide some of these benefits and extensions or changes or adjustments. It's a give and take, and it's really centered around can they make some of these benefits that we've been used to, or these tax reform benefits, without increasing the deficit that we're hearing a lot about. And that's kind of the trade. So they're trying to look for some ways to raise income and then offset it. But I think the big one, because we hit on so much of the original Tax Cuts and Jobs Act, a big part of the discussion going on right now is that's really about extending those. I'm reading notes just here just to make sure we cut it right. It's really this. It includes maintaining that lower income tax rate, preserving those business credits that Jason highlighted there, making sure the child tax credit's still in place, simplifying the tax code still with standard deductions. So it's really about making what we business as usual for the last 4 years, but just extending that so that way we're not struggling with, oh wow, I just lost an extra 10 or 15% of my pay. So that's the big one that you're hearing a lot about. That one's loaded with a lot of cost, as you can imagine, on the tax side of things. So I think that'll be the one that's going to be heavily debated.
Right now in the House Ways and Means Committee, there's a big conversation going on right now with the elimination of taxes on tips and overtime. Interesting, right?
Mm-hmm.
And what they want to do is introduce that bill by the time that we post this conversation, and eliminating those kind of taxes, providing relief to workers who rely on tips and overtime income in order to achieve their own personal financial goals. Think about what that is. And I do look at the notes, and there was one that I didn't see on the notes, but I want to make it a point, Andy, is there was that on the campaign trail, Trump's campaign trail, of elimination of Social Security income tax.
Yeah.
So those who receive Social Security, good chance, a lot of people that listen to our podcast from the demographics we represent, 85% of the Social Security benefit is subject to ordinary income tax. Now, that could be offset by the standard deduction that was so high before, but not so much going forward, right? So what does that look like if to not tax Social Security? As a teaser, I like what Andy said earlier. That's a podcast in itself. But if we don't tax Social Security, what does that mean for the trust fund and the deficit that's already imposed by the Social Security trust fund? Does that mean that it would be depleted sooner, unless there's emphasis around Social Security reform? You see how we're talking about these topics, but they're all connected and they all have a string together. It's at the end of the day, it's like, what are you doing to prepare? What are you doing to adjust? Are you able to pivot? Right? It's about that clear picture in your own personal finances, so that you can make a better informed financial decision. Now, in an effort for me to get off my soapbox, I'm going to kick it back to you, Andy, on what they're looking at doing with corporate tax rates as well.
Yeah, and the last one I think we're highlighting, because we've tried to hit the big three that just applied to everybody, is they're talking about the reduction of the corporate tax rate. So currently the corporate, so if you're filed as a C Corp, that's the big one. So US Corps, everybody that's kind of benefited more from the individual, tax strategies, that's not really applicable here, but it could be something you end up looking into. But currently it's going to they're proposing it to go from 21% to 18%. This is really designed to stimulate businesses. If it's cheaper from a tax side of a business to do business here and pay less taxes, that is where they anticipate would add to economic development and stimulation, just because more businesses will hire and work. Now, to Jason's earlier point, that is not a requirement, a lower tax rate just means it's a lower tax rate. If that business decides to pocket that and distribute to shareholders, they can. But the overwhelming thought is that if we have a lower cost of doing business from the taxes for business owners at the corporate level, then likely there would be some kind of trickle down for that. So, just think about it. If you're a business owner, there's a lot on the docket, a lot of discussion to be had out there. If you are someone that is maybe more on a fixed income, whether it's relying on tips or relying on some overtime income to pay the bills, or you're at Social Security check that you don't want to be taxed on, those are there's some changes and some proposals in there to make that hardship a little bit less or a bit more beneficial. And then I think the big one, as we've highlighted, is the big renewal of business as usual. And I hope that everybody, is able to maintain the same life as we transition through this higher cost of living that we've been under the last few years. So I think those are the big highlights. Jason, anything to add on the corporate side on your end, or any of those other main points?
Main point to wrap us up is, what conversations are you currently having with your spouse, with your financial advisor, with your accountant? Ask these questions. I think it's really important to sit down and take a look. I'm already doing what if analysis. Everything stays the same, but what if these taxes change? What does that look like? Like, I have access to financial planning approaches and software to then run advanced analysis. What if the tax code job act expires? What does that look like? How does that impact you from an income perspective and a tax perspective? Do we have to adjust your withdrawal strategy in retirement? Do we have to adjust your saving strategy while you're working? All these different things come into play so that you can still be able to reach your financial goals and live the life that you deserve. But with that being said, this is where listening to a podcast only takes it so far. You got to take action. I was talking with my wife the other day. She was like, "Man, when you listen to like these podcasts, when you read a book, like you take action on it, right?" And I was like, "Well, yeah. By me reading the book doesn't do anything. I then got to take that information and then be able to apply it."
Yeah.
But with that, go apply this information. Go speak to a qualified financial advisor and your accountant so you can make better decisions on your own. With that being said, that was Andy, the man merchant. I'm Jason Noble. You just watched and listened to 20 minutes of clarity. We hope you came in somewhat confused and foggy on tax reform, but left with clarity. Thank you so much and have a great rest of your day.